Welcome to Chapter 6. Understanding how stock prices are determined is essential for anyone looking to invest successfully. Stock prices are influenced by a complex mix of factors, including supply and demand, economic indicators, company performance, and market sentiment. In this chapter, we'll break down these dynamics and explore how they shape price movements in the stock market. To make these concepts practical, we'll dive into real-world examples and strategies. From using fundamental analysis metrics like P/E ratios to evaluate a company's financial health, to understanding how investor emotions like fear and greed drive market volatility, this chapter will equip you with the tools needed to make informed investment decisions while managing risk effectively. Chapter 6: How stock prices are determined. Understanding how stock prices are determined is crucial for anyone looking to invest successfully in the stock market. Stock prices fluctuate continuously, influenced by an array of factors that interact in complex and often unpredictable ways. This chapter delves into the dynamics of supply and demand, economic indicators, company performance, market sentiment, and external events. To make this knowledge more actionable, we will also explore risk management strategies that investors can use to mitigate potential losses in volatile markets. 6.1 Supply and Demand Dynamics. At the core of stock price movements lies the basic economic principle of supply and demand. This interaction is fundamental in determining a stock's price at any given moment. 6.1.1 The Law of Supply and Demand. 1. Supply refers to the number of shares available for sale in the market at various price points. If a company issues more shares than there is demand, prices tend to fall. 2. Demand represents investors' desire to purchase shares at certain price levels. High demand typically leads to rising prices. The interaction between buyers and sellers establishes a stock's market price. When demand exceeds supply, prices rise. When supply exceeds demand, prices fall. 6.1.2 Market Equilibrium. The market seeks a dynamic equilibrium, where the quantity demanded equals the quantity supplied. This balance shifts with new information or changes in investor sentiment. Practical example. If a company like Tesla reports breakthrough advancements in battery technology, investor demand for its stock may surge, driving up prices as more buyers enter the market than sellers. 6.2 Factors influencing stock prices. While supply and demand dynamics are essential, numerous other factors influence these dynamics and drive stock prices up or down. These factors often interact in complex ways, making it difficult to predict how they will affect stock prices under different conditions. 6.2.1 Economic Indicators. Several macroeconomic indicators have a profound impact on stock prices. 1. Gross Domestic Product, GDP. A growing GDP typically signals a healthy economy, which can drive higher corporate earnings. 2. Inflation. High inflation can reduce corporate profitability by increasing costs, leading to lower stock prices. 3. Interest rates. Low interest rates make borrowing cheaper for companies, often leading to rising stock prices as companies invest in growth. 4. Unemployment rates. Low unemployment often leads to increased consumer spending, boosting corporate profits and stock prices. Real-world example. In 2022, the U.S. Federal Reserve raised interest rates several times to combat inflation. This had a negative impact on growth stocks like Amazon, which rely heavily on borrowing for expansion. As borrowing costs increased, Amazon's stock price declined due to lower profit expectations. 6.2.2 Company Performance. Stock prices are directly influenced by a company's financial performance. 1. Earnings reports. Companies that consistently meet or exceed earnings expectations tend to see their stock prices rise. 2. Revenue growth. Investors reward companies showing strong revenue growth. 3. Dividends. Regular dividend payments can make a stock more attractive. 4. Management and leadership. Effective management boosts investor confidence, while poor leadership can cause uncertainty. Practical application. Using fundamental analysis. Investors can use fundamental analysis metrics, like the price to earnings, PE, ratio or earnings per share, EPS, to evaluate a company's financial health. 1. PE ratio measures how much investors are willing to pay per dollar of earnings generated by the company. Example: if company X has an EPS of $5 and trades at $100 per share, its PE ratio would be 20, $100, $5. A high PE ratio might indicate high growth expectations, but could also suggest overvaluation if growth does not materialize as expected. 2. EPS indicates how much profit is allocated to each outstanding share of common stock. Example: if company Y reports an EPS increase from $3 last year to $4 this year, it suggests improved profitability, a positive signal for potential investors. 6.2.3 Market sentiment and investor psychology. Investor psychology plays a significant role in driving short-term price movements. Beyond just fundamentals like earnings or economic data, key cognitive biases influencing stock prices. 1. Herd behavior, bandwagon effect. Investors often follow the actions of others, without conducting their own analysis, leading to bubbles or crashes. Example: during speculative bubbles like the dot-com bubble, 1997 to 2000, many investors bought tech stocks simply because others were doing so, inflating valuations far beyond reasonable levels until the bubble burst in 2000. 1. Fear and greed cycle. Fear drives panic selling during downturns, as investors rush for safety. Greed fuels excessive buying during bull markets, when investors chase quick profits without considering potential risks. Example: in March 2020, fear surrounding COVID-19 led to massive sell-offs across global markets, as investors fled risky assets, despite long-term fundamentals remaining intact for many companies. Case study: the GameStop short squeeze, 2021. In January 2021, retail investors on platforms like Reddit's Wall Street Bets banded together to buy GameStop shares en masse. 1. This collective action was driven not by fundamentals, but by herd behavior, and a desire to squeeze hedge funds that had heavily shorted the stock. 2. The result was an astronomical rise in GameStop's share price, from around $20 in early January 2021 to over $400 at its peak later that month, an event fueled largely by herd mentality, rather than any improvement in GameStop's business fundamentals. 6.2.4 External events. External events beyond a company's control can significantly influence stock prices across industries. 1. Geopolitical events. Wars or trade disputes can disrupt markets. Example: the US-China trade war caused significant volatility across sectors dependent on international trade. 2. Natural disasters. Events like hurricanes can impact specific industries, such as insurance or energy production. Example: Hurricane Katrina in 2005 caused energy stocks like ExxonMobil to fluctuate, due to disruptions in oil production along the Gulf Coast. 3. Technological advancements. Breakthrough technologies can propel stocks upward, as investors anticipate future growth potential. Example: Tesla's advancements in electric vehicle technology have consistently driven its stock price higher over time, as investors bet on its leadership in this emerging industry. 6.3 Investment Strategies. Investment strategies help investors navigate different market conditions by providing frameworks for making informed decisions about buying or selling stocks based on analysis techniques suited best, depending upon specific circumstances encountered along their investment journey. 6.3.1 Fundamental Analysis. Fundamental analysis involves evaluating a company's financial health by examining its financial statements, income statement, balance sheet, as well as broader economic indicators, such as GDP growth or interest rates globally today. Key metrics used in fundamental analysis. 1. Price to earnings, PE, ratio. Measures how much investors are willing to pay per dollar of earnings generated by the company. A high PE ratio may indicate high expectations for future growth, but could also suggest overvaluation if growth does not materialize as expected. Example: a PE ratio of 20 means investors are willing to pay $20 for every $1 of earnings generated by the company over the past year. 1. Earnings per share, EPS. EPS indicates how much profit is allocated to each outstanding share of common stock. It is calculated as net income divided by the number of outstanding shares. Example: if company X has an EPS of $5 and trades at $100 per share, its PE ratio would be $100, $5 equals 20. 1. Price to sales, PS, ratio. This ratio compares a company's market capitalization with its total revenue over the past year. It is useful for evaluating companies that may not yet be profitable, but show strong revenue growth potential, for example, startups. Example: a PS ratio below 1 might indicate undervaluation compared with peers if revenue growth prospects remain strong. 1. Return on equity, ROE. ROE measures profitability relative to shareholders' equity and indicates how efficiently management is using equity capital invested into business operations. Example: a high ROE suggests efficient use of capital. If company Y has an ROE of 25%, it generates 25 cents in profit for every dollar invested by shareholders. 6.4 Risk management. Investing involves various risks. Understanding these risks is crucial for protecting your portfolio from significant losses during volatile market conditions. Types of investment risks. 1. Market risk. The risk that overall market conditions will cause asset values to decline regardless of individual company performance, for example, during recessions. 2. Company-specific risk. The risk associated with individual companies due to poor management decisions or operational failures that could lead to declines in their stock price. 3. Systemic risk. The risk that an event affecting an entire financial system, such as a banking crisis, will cause widespread declines across all asset classes. Risk mitigation techniques. 1. Diversification. Involves spreading investments across different asset classes, for example, stocks, bonds, or sectors, for example, technology versus healthcare, so that poor performance in one area does not disproportionately affect your entire portfolio. Practical example: an investor holding both tech stocks like Apple and energy stocks like ExxonMobil would be better protected against sector-specific downturns than someone holding only tech stocks during periods when technology underperforms relative other sectors due external shocks beyond control entirely altogether separately apart distinctively unique unto itself. Alone standing independently apart detached disconnected severed broken off split away fractured disjointed ruptured torn apart shredded fragmented.